Hello everyone, this is Ankit here, Chartered Accountant. Today we are going to talk about what are the tax implications from selling your technology or a software business. So here we are trying to simulate what would be the tax impact. So we are talking about three options available for you. The first option is a slump sale. So what happens in a slump sale is, let's take an example. If you're running a software company, there may be two divisions in your company. So the first division is into development of software, and the second division is services division. So in such a case, and you get a buyer who is interested to acquire only the software business of your company. In such a case, you can transfer only the software business and retain the services business in your existing company. So the buyer will just take the business out of this existing company. Now the second option is, okay, maybe your software company as such, the buyer is not interested. He's only interested in a software or say a database or maybe certain designs which is very interesting. So in such a case, the buyer will can only acquire that particular software or a website or some intellectual property which you have, and the rest of the business will still retain with you in the company. The third option is the very simple option here. That means you transfer the whole company to the buyer. So it's a very simple process where you transfer the shares of your company and the buyer becomes the owner of the company as well as the business and everything. So these are the options available. Now let's look at what happens on the taxation side if you choose any of these options. Let's look at the first option now, slump sale. Under the slump sale, you need to see uh, whether the business you're selling now is at least 36 months old. So have you held the business for 36 months? In that case, this business will be treated as a long-term capital asset, and any resultant gain that you have will be a long-term capital gain. So if it is a long-term capital gain, then the tax rate is 20%. And if not, the tax rate is a normal corporate tax rate that is applicable for your company, which is 22 to 25%, which is excluding the cess and the surcharge which may be applicable. So here, when you are calculating the capital gain, you have to note that the sale consideration which you realize from sale of this software business will be reduced by the net worth of that segment. So it's a software business. So asset minus liability will be the net worth of that particular business segment will be considered as a cost for calculating the capital gain. Now the second option, which is sale of the IP. So in this case, it will be similar to the slump sale. However, you have to make sure that if you are selling the IP which is acquired, that means you bought this software or that website from a third party. In that case, it will be treated as a short-term capital asset for all purposes. So the normal corporate tax rate is applicable, which is 22 to 25%. And if you have generated the IP, that means you have developed the software or you have developed the website, in that case, it will be treated as a long-term capital asset if you're holding it for a period of 36 months or more. So here I think the trigger date can be from when did this software generate or started generating revenue for you. So that can be the date from which you can calculate whether it is a long-term capital gain or a short-term capital gain. If it is a long-term capital gain, then the normal capital gain tax, that is 20%, is applicable. And in case if it is short-term capital gain, then 22 to 25%, that is a normal corporate tax, is applicable. Under option 1 and 2, you have to specifically note that apart from the capital gain of 20% or the other normal corporate tax which you would have paid, I will assume that if you are in a highest tax bracket, you need to pay additionally 30% on that profit to withdraw it from the company for your own purposes. Coming to the third option, that is sale of software business by selling the shares in your company. That means you transfer the whole company as well as the business to the buyer. As I said earlier, this is the simplest way of transferring the business. Here, again, you have a long-term capital gain or a short-term capital gain. The short-term capital gain is attracted if you are holding that company shares for less than 24 months. In that case, you need to pay a tax rate of 30%, which I am assuming is the maximum tax bracket at which you are. So in case you are holding for more than 24 months, then it will be long-term capital gain. Now, you will be paying tax at 20%. Another additional benefit you need to consider here is in case of a long-term capital gain, you will also get an indexation benefit. Here, by indexation, I mean you will get inflation index that will be adjusted to the cost of acquisition. That means how much of capital you had invested initially as share capital will be adjusted to the inflation. So this will help in reducing the tax outflow. So to summarize, as you can see under the option 1 and 2, that is slump sale and sale of IP, you will have to pay almost 50% or maybe more than 50% of the sale consideration just towards the taxes. Whereas under the option 3, that is sale of shares, you will only have to pay the capital gains tax. So you have to be very careful when you are uh, maybe looking at designing the transaction with the buyer and then taking a decision on how you want to transfer the software business. Also, I would like to point out that there are certain things that you need to keep in mind well before getting into such transactions. You need to ensure that you have all the documentations right, that is property titles, share certificates, which is very crucial. And you may also need to have contracts with employees, your best customers, and in organization chart. You also need to look at cash flow statements and forecasts. And also, most important thing is your compliance records, whether you have been complying with all the regulations timely basis and you have all the records in place. So with all these in kept intact for the company, it will help you to transfer the business with the company instead of just the business. So ensure that you take care of all these points. By that, your tax incidence will also come down and you keep maximum profits in your pocket. That's it. Thank you for listening.